everyone! Welcome to the fifth episode of the Accounting Starter series. In this episode, we will learn how to journalize transactions relating specifically to merchandising businesses. We'll start off with a brief discussion of the differences between merchandising and service type businesses. We'll also talk about new terms and concepts that are related to the merchandising business. Then we'll discuss some new formulas and move on to the two types of inventory systems, the periodic and perpetual inventory systems. After that, we'll go over the journal entries for common merchandising transactions that we haven't covered in the previous episode. We'll also talk about freight and shipping terms, discounts, and markup, which are topics specifically relating to merchandising. Last, we'll apply these concepts by journalizing merchandising transactions. Today's lesson will cover a lot more topics compared to the previous episodes, so hang in there. Now let's start with the differences between merchandising and service type businesses. First, we'll talk about the differences in their nature and activities. Merchandising businesses are engaged in the buy and sell of goods, which are referred to as inventory. These goods are sold in their original form and are not processed further. Activities specific to merchandising businesses include purchasing, handling, return of goods purchased, sale of goods, return of goods sold, and inventory management. Purchasing involves maintaining records of the kind, quality, quantity, and cost of goods purchased by the company. Handling refers to the transportation or delivery and sorting of goods purchased. Return of goods purchased occurs when the items received do not meet the standards of the company. For example, goods are damaged or items received are of a different make or model. And in this case, goods are returned or deductions to the original price may be granted by the vendor. Sale of goods is quite self-explanatory and involves selling goods to customers at prices above the cost or at a profit. Next, we have return of goods sold. In some cases, customers may be dissatisfied with the quality of the goods received and may return these to the company. Reductions in the selling price may sometimes also be granted if goods are not returned. Inventory management is concerned with maintaining the right level of stocks of inventory on hand to make sure that the company can satisfy customer orders at all times, but also avoid having too much inventory to minimize costs. Service-type businesses, as we discussed before, is concerned with the provision of services to clients. There are various types of services like accounting services, bookkeeping, counseling, travel agency, car wash, and repairs. Here we have the account names specific to merchandising transactions. We've actually introduced these in part 2, but let's go through them briefly. As we mentioned, a merchandising company is engaged in both the buy and sale of goods. On the left side, we have account names relating to the purchase of inventory, while on the right, we have account names relating to the sale of goods. Written beside each account name is its normal balance. Take note that all of these are income statement accounts. First, we have purchases, which is used to record the purchase of goods. It has a normal debit balance because it's actually a type of an expense. Later, you'll understand why when we go through the formulas for cost of goods sold. Next, we have purchase returns and allowances. This account is used to record any returns made by the company and any allowances or reductions in price due to defects granted by the seller. Since this reduces the cost of purchases, this has a normal credit balance. Purchase discounts also has a normal credit balance since this represents reductions in the cost of purchases. The account is used to record the discounts granted by the suppliers for payments made within the discount period. Next, we have freight in or transportation in. It has a normal debit balance because this is a type of expense. This pertains to the delivery or shipping costs related to the purchase of inventories. So instead of delivery costs, the specific account name we use is freight in or transportation in. Next, we have sales, which of course is used to record the sale of goods to customers, whether for cash or on credit. This has a normal credit balance because this is a form of income. Sales returns and allowances is used to record the return of goods by customers and any allowances granted by the company to its customers. It has a normal debit balance because it reduces the amount of sales of the company. Next, we have sales discounts, which is used to record the discounts granted by the company to its customers for payments made within the discount period. Again, this also has a normal debit balance because it reduces the amount of sales of the company. Last, we have freight out or transportation out, which is the counterpart of freight in. This account pertains to the delivery or shipping costs relating to goods sold to customers. Take note that the sales and sales returns and allowances are recorded at the selling price, while purchases and purchase returns and allowances are recorded at the cost of purchase. Next, we also have a balance sheet account, merchandise inventory, which is classified as a current asset. This represents the goods or stocks to be sold by the company which are still on hand. Now, when journalizing merchandising transactions, two documents we often encounter are the debit memo or the debit memorandum and the credit memo or the credit memorandum. Both of these documents indicate the same thing, that there is a reduction in the account balance because of a return of merchandise or the granting of an allowance. One of the differences lies with the preparer. The debit memo is issued by the buyer to tell the seller that he will be debiting the accounts payable he has recorded in his books. Remember that the accounts payable has a credit balance, so the customer is telling the seller that he will be debiting or reducing the accounts payable because of a return of merchandise or an allowance granted by the seller. The credit memo, on the other hand, is issued by the seller to inform the customer that he will be crediting the customer's account or the accounts receivable recorded in the seller's books for the amount of returns or allowance granted. If you find it confusing, just remember that both of these documents will result in a reduction of the accounts payable or receivable. Now, which account is reduced by debiting? Accounts payable, right? So the debit memo reduces the accounts payable, which is recorded by the buyer. So you'll remember that the debit memo is prepared by the buyer. When encountering these documents while journalizing, it's important to check three things. 1. Is the company the seller or the buyer in the transaction? 2. Did the company issue or receive the document? And 3. What document is involved? Is it a debit memo or a credit memo? For example, if the company is a buyer and it issues a debit memo, then it means that there will be a decrease in its accounts payable balance. If the company is the seller and it receives a debit memo from the customer, then it means that there will be a decrease in its accounts receivable balance. Now we'll talk about the formulas commonly used in merchandising. First, we have net income. We know that the general formula for net income is basically the total income less total expenses. For merchandising businesses, the main source of income is the sale of goods, which is why we have a separate section to present this. This section presents the gross profit of the company, which is computed as net sales less the cost of goods sold. From the name itself, net sales, we have net, which means after deductions. Net sales is therefore computed as total sales or gross sales less any sales returns and allowances less any sales discounts. Another important formula is the cost of goods sold. It's computed as the inventory at the beginning of the period plus the net cost of purchases less the amount of inventory at the end of the period. Let's take a more detailed look at the components. This part here, purchases minus purchase discounts minus purchase returns and allowances, gives us the net purchases. You'll notice that the formula is similar to how we computed for net sales, only instead of sales, we have purchase accounts. Adding the amount of freight in or the delivery costs will give us the net cost of purchases. Then we add the inventory at the beginning of the period to the net cost of purchases during the period, and we get the total goods available for sale. And by deducting the amount of inventory ending, or the amount of inventory that remains unsold as of the end of the period, from the total goods that could be sold during the period, we get the portion that has been sold, or the cost of goods sold, which is also referred to as the cost of sales. Now let's talk about the two types of inventory systems used to monitor the company's inventories. A merchandising business uses an inventory system to value the inventory it has on hand at the end of the period. This system may either be the perpetual inventory system or the periodic inventory system. We will now go through the differences between the two. The first main difference lies in the process. Under the perpetual system, the inventory balance is updated after every transaction, whenever there is a sale, a purchase, or a return to the vendor or by a customer. Because the inventory is always updated, the company has a continuing summary or a running balance or the correct amount of inventory readily available at any point in time. Under the periodic inventory system, the inventory balance is only updated periodically, for example, at the end of the year or every 6 months, when the physical count of the goods is performed. Another difference would be the account names used to journalize the entries. Under the perpetual inventory system, we only have the merchandise inventory account, a balance sheet account, and the cost of goods sold account, which is an income statement account. The merchandise inventory account is used to record all transactions, may it be purchases, purchase returns, purchase discounts, and freight. The amount of goods sold to customers is directly recorded using the cost of goods sold account. Under the periodic system, we have a separate account for each transaction. We have purchases, purchase returns and allowances, purchase discounts, and freight in. The merchandise inventory account is also maintained for the amount of inventory available at the end of the reporting period. You'll also note that the periodic system does not make use of the cost of goods sold account. Since the cost of goods sold account is updated for every sale and sales return under the perpetual system, we don't need to use the formula to compute for cost of goods sold to determine the total amount of cost of sales for the period. The information would be readily available in the company's books at any time. As we also mentioned earlier, the periodic system does not make use of the cost of goods sold account. Instead, the total amount of cost of sales is computed using the formula we discussed earlier at the end of the period after the physical count is completed. The last difference would be the conduct of physical count. Under the perpetual system, a count is performed mainly to check the accuracy of records. But for the periodic system, the physical count is necessary in order to determine the amount of inventory on hand or still unsold at the end of the period. And obtaining the amount of inventory at the end of the period is necessary to be able to compute for the cost of goods sold during the period. Okay, now let's proceed to journalizing common merchandising transactions. We'll be discussing the journal entries under each type of inventory system. First is the purchase of inventories from the supplier, which may be made by paying cash or on account. The value received here, or the debit, would be the inventory purchased. Again, under the perpetual inventory system, most transactions are recorded using the merchandise inventory account. So we debit merchandise inventory and credit cash if the purchase was made by paying cash, or credit accounts payable if it was made on account. It's the same for a periodic system, only instead of merchandise inventory, we debit a more specific account called the purchases account. 2. Return of purchase inventories to supplier or the granting of allowance. Since this is a decline in the cost of inventory, an asset, we credit merchandise inventory under the perpetual system and debit accounts payable or cash if there is a cash refund. It's the same for the periodic system, only again we use a more specific account for this transaction. We use purchase returns and allowances instead of merchandise inventory. 3. Partial payment of outstanding balances. This is similar to what we've covered in the previous episode, where we simply debit accounts payable and credit cash. We use the same entry for both systems. 4. Full settlement of outstanding accounts within the discount period. Because the payment was made within the discount period, the company is entitled to a discount. Since it is a reduction in the cost of inventories purchased, which we initially debited, we make a credit to merchandise inventory for the perpetual system or a credit to purchase discount under the periodic system. Since this is also the day when the outstanding balance is settled, we also make a debit to accounts payable and a credit to cash. 5. Full settlement of outstanding accounts beyond the discount period. Because the payment was made beyond the discount period, the company will not be entitled to discounts. So we use the normal entry for settlement of balances. We debit accounts payable and credit cash for both systems. 6. Period end adjustment. This adjustment is made to make sure that the amounts of inventory at the end of the period and the cost of goods sold during the period will be correct. We do not need an adjustment for the perpetual inventory system since, as we discussed earlier, the inventory and COGS balances are updated every transaction. To record the adjustment under the periodic system, we debit merchandise inventory and credit income summary. Later on, we'll discuss more about this. 7. Sale of inventories on account or on cash basis. The entry here is similar to the entry we make when recognizing income from providing services, only instead of service income, we credit sales. We debit cash if the sale is made on a cash basis, or debit accounts receivable if it was made on account. This is the same for both the perpetual and periodic systems. The only difference is under the perpetual system, we are required to update the balance of inventory, so we make another entry. Since the inventory was already sold, we credit merchandise inventory, and then we debit COGS, or cost of goods sold, to recognize the cost or expense related to the sale. Take note that sales is recorded at the selling price, while COGS and merchandise inventory are recorded at cost. 8. Returns of goods sold. For both systems, we debit sales returns and allowances since this account reduces the amount of income or sales of the company, and credit accounts receivable or credit cash if there is a cash refund. But again, take note that under the perpetual system, we are required to update the inventory balance, so we make another entry. Since the inventory was returned to the company, we debit merchandise inventory and also reduce the cost related to the original sale by crediting cost of goods sold. 9. Partial collection of outstanding balance. This is similar with how we journalized collection in the previous video. We simply make a debit to cash and credit accounts receivable. 10. Full collection of outstanding balance within the discount period. Since there is a collection, we debit cash and credit accounts receivable. But here, the customer is entitled to a discount, so we also need to record sales discount. We make a debit to sales discount since this reduces the company's sales. 11. Full collection of outstanding balance beyond discount period. Here we debit cash and credit receivable similar to a normal collection of balance. No discount is recorded since payment was made beyond the discount period. Alright, so earlier we mentioned that a year-end adjustment is required under the periodic system. But why do we make this entry? Why do we make a debit to merchandise inventory and a credit to income summary? A lot of students would just memorize this entry without really understanding why, but allow me to explain. Take for example this scenario with these transactions. We'll analyze the difference in balances when these transactions are recorded under the perpetual and periodic inventory systems. First, let's compute for the should-be balances, regardless of the inventory system to be used. What are the correct amounts for inventory at year-end, cost of goods sold, and the net income for the period? Based on number 6, inventory at the end of the year is 100,000 pesos. Then we get cost of goods sold by adding the cost of inventory sold in transactions 2 and 4. 30,000 plus 50,000, we get cost of goods sold of 80,000 pesos. Last, we compute for net income. We get this by deducting the cost of goods sold from the total sales during the period. Total sales from transactions 2 and 4 would be 60,000 plus 100,000 or 160,000. Deducting cost of goods sold of 80,000, we get a net income of 80,000. Now let's compare the impact of the different inventory systems on the merchandise inventory and the cost of goods sold balance of the company. 1. Purchased inventory amounting to 120,000 pesos. For this transaction, we debit merchandise inventory under the perpetual system, which means that there is an increase of 120,000 in the merchandise inventory balance and no impact on the cost of goods sold. Under the periodic system, we debit purchases. Recall that when we discussed the formula earlier, purchases is added to inventory beginning to get the cost of goods sold for the period. So this means that the increase in purchases increases the cost of goods sold but has no impact on the merchandise inventory balance of the company. 2. Sold inventory costing 30,000 pesos for 60,000 pesos cash. Under the perpetual system, the inventory balance is updated for every transaction, and a sale is recorded as debit or an increase in cost of goods sold and a credit to or a decrease in merchandise inventory. Take note that merchandise inventory and cost of goods sold are always recorded at cost, in this case 30,000 pesos, and not the selling price. There will be no impact on both accounts under the periodic system since the inventory balance will only be updated at the end of the period once the physical count has been completed. 3. Purchased additional inventory amounting to 50,000 pesos. The impact of this transaction will be the same as the first transaction. We have an increase in merchandise inventory of 50,000 under the perpetual system and an increase in cost of goods sold of 50,000 under the periodic system. 4. Sold inventory costing 50,000 pesos for 100,000 pesos cash. The impact of this transaction would be similar to the impact of the second transaction. The sale will result in a decrease in merchandise inventory of 50,000 and an increase in the cost of goods sold of 50,000 under the perpetual system. There is no impact on both accounts under the periodic system. 5. Purchased additional inventory amounting to 10,000 pesos. The impact of this transaction will again be the same as transactions 1 and 3. Under the perpetual system, merchandise inventory will increase by 10,000 pesos and COGS will remain unchanged. Under the periodic system, COGS will increase by 10,000 pesos and merchandise inventory will remain unchanged. The sixth transaction refers to the physical count, which will be used for the period end adjustment. But before we do that, let's take a look at the balances before any adjustment is recorded. You'll note that under the perpetual system, merchandise inventory is 100,000 pesos, and this is the same as the should-be balance we computed earlier. The cost of goods sold balance is 80,000, which is also the same as the should-be balance we computed. This means that we do not need to make any adjustments. The records already reflect the correct amounts for merchandise inventory and the cost of goods sold, and in turn also the net income. Now, if we look at the balances under the periodic system, merchandise inventory is currently 0, meaning it is understated by 100,000 compared to the should-be balance. Cost of goods sold is at 180,000, meaning it is overstated by 100,000 compared to the should-be balance. Since the cost of goods sold is a form of expense, the overstatement in the cost of goods sold will understate the net income by 100,000 as well. These are the balances before any adjustment is recorded. As we discussed earlier, merchandise inventory is currently at 0 and is understated by 100,000. COGS is 180,000 and is overstated by 100,000. Right now, the company has a net loss of 20,000 and this amount is understated by 100,000. So what can we do to correct these balances? First, we need to increase inventory by 100,000, which is the result of the physical count conducted in transaction 6 above. To do that, we debit inventory by 100,000. Debiting inventory will increase the merchandise inventory balance by 100,000. Increasing merchandise inventory will also decrease the amount of cost of goods sold by 100,000 because if you recall the formula earlier, to compute for cost of goods sold, we deduct the amount of inventory. Next, to correct the balance of net income, which is currently understated, we should increase it. Remember that income has a normal credit balance, right? So to increase net income, we should credit the income summary account. This is a new account to you, and this will be covered once we discuss the closing process. But for now, you can just think of it as a kind of an income account, and by crediting it, we would be able to increase the net income. After crediting the income summary account for 100,000, net income will also be increased by 100,000. After effecting the adjustments, you'll see that the adjusted balances here already agree with the should-be balances here on the left. And this is why the period end adjustment requires a debit to merchandise inventory and a credit to income summary, because under the periodic system, we don't record inventory on hand. We only do it at the end of the period, so we debit merchandise inventory to record or to recognize the inventory available at the end of the period. And also, based on the formula, the understated inventory also means that the cost of goods sold of the company is overstated before any adjustments are made. Alright, so now we're halfway through our lesson, and I know today's discussion is quite lengthy, but I hope you guys are still okay. Now we'll proceed to freight and shipping. First, let's talk about the freight terms. I think a lot of you are actually quite familiar with the concept of freight. It's just that you aren't really aware that you're already dealing with freight. Freight terms are actually the shipping terms. So when you're buying something online, for example, from Shopee or Lazada, you're usually going to ask, who shoulders the shipping fee? And in substance, this is actually what freight terms is all about. When we talk about freight terms, the information is usually divided into two parts. Here I'll present it as Part A and Part B. Part A tells us who must shoulder the freight cost, who will be the one recording the expense in its books. Recall that for merchandising businesses, sellers use the freight out or transportation out account, while buyers use the freight in or transportation in account. These pertain to delivery costs or expenses, so these are debited by the person shouldering the expense. While in transit, the risk and ownership of the goods will belong to the person who shoulders the freight cost. For example, if the goods disappear while in transit, the person who shouldered the freight cost will be the one to bear the loss. Part B provides the information about the party making the initial cash payment. Who will be making the payment to the carrier or the shipper first? Who will be recording the cash outflow or making the credit to cash in its books first? If the party who must shoulder the cost is not the same as the party making the cash payment first, then a receivable or a payable should be recorded. We will discuss more about this in a little while when we go through the journal entries. Freight terms are usually presented as a combination of A and B. Part A can either be FOBSP or FOBDP, while Part B can either be collect or prepaid. For example, we can have FOBSP collect, or FOBSP prepaid, or maybe FOBDP collect and FOBDP prepaid. So what exactly do these terms mean? Again, Part A tells us which party must shoulder the cost. Free on board shipping point, or FOBSP, means that the seller is free of responsibility once the goods are on board the shipper. This tells us that the buyer will be the one to shoulder the freight costs, so the buyer will debit freight in its books. Since the buyer is the one shouldering the costs, risks and ownership are transferred to the buyer once the goods are shipped or once received or loaded onto the carrier or shipper. Free on board destination point or FOBDP is the opposite. The buyer is free of responsibility while the goods are on board the shipper. Here, the seller shoulders the freight cost, and any risks and ownership are only transferred to the buyer once it reaches the destination point or once received by the buyer. Here we have an illustration. If the freight term is FOB shipping point, the buyer shoulders the freight. This means that the buyer is responsible for the goods from the point of shipment once the carrier receives the goods until it is transported to the buyer at the destination point. This means that the buyer owns the goods and is responsible for any losses during this period. If the freight term is FOB destination point, the seller shoulders the costs and records the freight expense. This means that the seller is responsible for the goods from the point of shipment until it is transported to the buyer at the destination point. This means that the seller owns the goods and bears any losses during this period. Part B tells us which party makes the cash payment first, who makes the actual cash payment to the carrier. Take note that the party making the initial cash payment does not necessarily have to be the party shouldering the cost. Prepay tells us that the seller is the one making the initial cash payment. Collect tells us that the buyer will make the cash payment first. To summarize, for Part A, we determine the party recording or debiting the freight expense account. We can either have FOB shipping point or FOB destination point. The buyer debits freight in under FOB SP, while the seller debits the freight out expense under FOB DP. For Part B, we determine the party crediting the cash account. We can either have prepaid or collect. The buyer credits cash under collect, while the seller credits cash in its books under prepaid. Again, we can make 4 combinations of freight terms: FOB SP collect, FOB SP prepaid, FOB DP collect, and FOB DP prepaid. Now we'll talk about the journal entries relating to the freight terms. And to journalize, you just need to ask 3 questions. 1. Is the company the buyer or the seller? 2. Will the company be the one shouldering the expense? And 3. Will the company be the one making the cash payment? First, let's try journalizing the freight term FOB shipping point collect. Who must shoulder the expense? For FOB shipping point, the buyer is the one shouldering the expense, so we debit freight in under the buyer's books. Next, we check who will be making the cash payment. The term is collect, meaning the buyer will be the one paying first, so we credit cash in the buyer's books. Since there is no mismatch between the party who should be shouldering the cost and the party making the initial cash payment, no entry is necessary for the seller under FOB shipping point collect. Then just check if the company is the buyer or the seller in this transaction. If the company is the buyer, you record debit freight in and credit cash, and if the company is the seller, no entry is necessary. Now let's try FOB shipping point prepaid. Who will be shouldering the expense? The buyer, right? So we debit freight in the buyer's books. Next, who will be making the cash payment? The seller, so we credit cash in the seller's books. Now you'll see that there is a mismatch between the party who is supposed to shoulder the cost and the party making the first cash payment. The technique is to fill in the missing entries with accounts payable in the buyer's books and accounts receivable in the seller's books. This is because the seller is expected to collect the amount from the buyer in the future, and the buyer is expected to pay that amount to the seller in the future. Then how do you know which entry to record? Just check whether the company is the buyer or the seller in the transaction. Next, we have FOB destination point collect. First, let's check who is supposed to shoulder the expense. For FOB destination point, the seller shoulders the expense, so the seller records debit freight out in its books. Next, who is the one making the initial cash payment? Here we have collect, so the buyer is the one recording the cash payment, so we credit cash in the buyer's books. Then we fill in the missing spaces with accounts payable in the buyer's books and accounts receivable in the seller's books. This is because the seller was supposed to shoulder the expense, but since the buyer paid in advance for the seller, the amount is deducted from the buyer's outstanding balance with the seller. After that, just check whether the company is the buyer or the seller in the transaction and record the appropriate entry. Now let's try FOB destination point prepaid. Again, let's check who will shoulder the expense. For FOB destination point, the seller shoulders the expense, so the seller records debit freight out in its books. Next, who makes the cash payment first? For prepaid, the seller is the one making the payment, so we credit cash in the seller's books. Since there is no mismatch between the one shouldering the expense and the one making the payment, the buyer does not need to record any entry. And again, after that, just check whether the company is the buyer or the seller and record the appropriate entry. So you don't really have to memorize all these entries. You just need to analyze each scenario. Who is the one shouldering the expense? Who makes the cash payment first? And if there is a mismatch, record accounts payable and accounts receivable. And then check if the company is the buyer or the seller in the transaction and just choose the appropriate entry. And now we'll be talking about the different types of discounts, how to compute, and also how to journalize them. First, we have trade discounts. This is the type of discount granted by suppliers to promote bulk or large volumes of purchases. Three terms you need to know here are the list price, the trade discount, and also the invoice price. When we talk about the list price, we're referring to the original catalog price before any trade discount is deducted. After deducting the trade discount from the list price, we get the invoice price, which is the net amount that is also recorded by the company. So how do we compute for the trade discount? Let's take a look at these examples. First, list price of 100,000 pesos less 20%. 20% is the discount rate, so multiplying 20% by 100,000, we get the trade discount of 20,000 pesos. To get the invoice price, we can deduct 20,000 pesos from 100,000 pesos, or simply multiply 100,000 pesos by 100% less 20%, or 80%, and we get 80,000 pesos. 2. List price of 100,000 pesos less 10 less 5. To compute for the invoice price, we simply multiply 100,000 pesos by 100% less 10% multiplied by 100% less 5%, or simply 100,000 pesos times 90% times 95%. And then we get an invoice price of 85,500 pesos. To compute for the trade discount, you can simply deduct the invoice price from the list price and you'll get 14,500 pesos. If the discount would have three rates, then you will just have to continue multiplying by 100 less the third discount rate to get the invoice price. So for example, if the discount rate is 10% less 5% less 2%, then to get the invoice price, you simply multiply 100,000 by 90%, by 95%, and by 98%. Here is another way to compute for the trade discount and invoice price, but I think this is a lot more complicated, so I recommend using the first method that I showed you. 3. List price of 100,000 pesos, trade discount of 20% and 10%. To compute for the invoice price, we use the same method as earlier. We multiply 100,000 by 80% and by 90%, and we get 72,000 pesos. To compute for the trade discount, we simply deduct the invoice price of 72,000 from the list price of 100,000, and we would get 28,000 pesos. Take note that the trade discount is not recorded using a separate account name. The trade discount is embedded or deducted from the price directly, and only the net amount is recorded in the company's books. For example, here we record the purchases and accounts payable at the invoice price of 72,000 pesos, which is the amount net of trade discount. Another type of discount is the cash discount, which is granted by the supplier to promote prompt or timely payment of balances. The cash discount is presented through the credit terms granted by the company. Usually we'll see it in this form: 315 and 60, or maybe 315, 210, and 30, and so on. These credit terms provide the terms or conditions of payment relating to the credit extended by the seller to the buyer for sales on account. The credit term would include information like the discount rate, the discount period, and the credit period. The numerator of the first fraction provides the discount rate. Multiplying the discount rate by the basis of the cash discount would give us the amount of cash discount granted to the buyer. The denominator here is the discount period, which gives the number of days from the date of purchase in which the buyer must fully settle the outstanding account balance to be entitled to the discount. The denominator of the last fraction with n or net as the numerator is the number of days from the date of purchase when the unpaid balance should be settled in full. Payment within the credit period but beyond the discount period is no longer entitled to the cash discount. The entire term is read as 315 net 60, and putting all the parts together, this credit term means that the buyer is entitled to a 3% cash discount if the balance is fully paid within 15 days and the remaining balance is due in full and must be paid within 60 days from the date of purchase. The buyer uses the purchase discount account, while the seller uses the sales discount account to record the cash discount. Now here are some key points to remember. First, cash discount is computed as the cash discount rate multiplied by the basis of the cash discount. So how do we compute for the basis of the cash discount? Since the discount is granted to encourage prompt payment, only sales made on account is entitled to cash discount. Any returns and allowances are also deducted since these would no longer be entitled to the discount. The net amount we get would be the basis of the cash discount. Another thing to note is that discounts will only be granted once full payment has been made. Discounts are not granted upon partial payments. Now let's try this problem. On June 1, 2020, ABC Company purchased inventories amounting to 100,000 pesos, paid 10,000 pesos cash, balance on account. Terms are 310, 215, net 30. Returned goods worth 10,000 pesos on June 5. Compute for the discount if balance was paid on June 11, June 16, or June 20. To compute for the discount, we must determine three things. Number 1, is the buyer entitled to the cash discount? Meaning, was the buyer able to fully settle the balance within the discount period? If no, then the answer for the discount would be 0 and we don't have to compute for anything. If yes, then we proceed to step 2. Compute for the basis of cash discount. As we mentioned earlier, this is the total purchases or sales on account less any returns and allowances. 3. Compute for the cash discount, which is the cash discount rate multiplied by the basis of cash discount computed in step 2. So before we solve this problem, we have to check the credit terms first. For this problem, the terms are 310, 215, net 30. This means that the buyer is entitled to a 3% cash discount if the balance is fully settled within 10 days and a 2% discount if settled within 15 days. The remaining balance is due in full within 30 days. Now let's compute for the discount if the balance was paid on June 11. First, is the company entitled to the discount? If the payment was made on June 11, it was made within 10 days. This means that the buyer is entitled to a 3% discount. Next, let's compute for the basis of the cash discount. Total purchases would be 100,000 pesos. But remember, only purchases on account are entitled to the discount, so we must deduct the 10,000 pesos which was paid in cash. Then we also deduct the 10,000 pesos worth of goods returned on June 5, and now we get the basis of 80,000 pesos. With that, we can now compute for the cash discount. 3% multiplied by 80,000, we get the cash discount of 2,400 pesos. The cash payment to be made by the company is 80,000 less 2,400 or 77,600 pesos. We can also compute for this as 80,000 pesos multiplied by 97%. Now let's compute for the discount if the balance was paid on June 16. Is the company entitled to the discount? If payment was made on June 16, it was made within 15 days. This means that the buyer is entitled to a 2% discount. The basis of the discount is still 80,000 pesos, computed the same way we did earlier. Now we can compute for the cash discount. 2% multiplied by 80,000 pesos, we get the cash discount of 1,600. The cash payment to be made by the company is 80,000 less 1,600 or 78,400 pesos. Last, let's compute for the discount if the balance was paid on June 20. Let's check if the company is entitled to the discount. Since payment was made within 19 days, the company is no longer entitled to any discount, so the discount would be 0 and the company would have to pay 80,000 pesos on June 20. Now, how would the company journalize this transaction? Assuming the payment was made on June 11, the full settlement would require a debit to accounts payable for 80,000 pesos, which is the entire unpaid balance as of June 11. Cash is credited for 77,600 pesos, the cash payment required, and purchase discount is also credited for 2,400 pesos. And how would the seller journalize this transaction? The seller would debit cash for 77,600 and debit sales discount for 2,400, then credit accounts receivable for 80,000 pesos. If payment was made beyond the discount period, the company would simply debit accounts payable for 80,000 and credit cash for 80,000. Okay, so now we're at the second to the last topic for today, and we'll be talking about markup, the different methods, and also computations. Now, what do we mean by markup? To understand markup, let's refresh our understanding of the formula, sales less cost of sales equals gross profit. The markup is the difference between the sales and the cost of goods sold. In Filipino, patong. Markup is commonly presented as a percentage, which we refer to as the markup rate. The markup rate is computed as the amount of markup divided by the base. The base can either be the sales or the cost of sales. So the formula will either be markup divided by sales or markup divided by the cost of sales. Of course, because the bases are different, we will also get different values for the rates, depending on which formula we use. There are various markup terms, and the most common ones you'll see would probably be markup on sales, markup on cost, and markup above cost. Because of the differences in the base, the percentages may also vary even if the amounts remain the same. For example, we have here sales of 100,000 and cost of sales of 75,000 and gross profit or markup of 25,000. If we compute for the markup rate based on sales, then we get 25%. If we compute for the markup rate based on the cost of sales, we get 33.33%. Both of them are correct. They are equivalents. To make sure that we are able to properly compute for the markup, selling price, and markup rates, it is therefore important to understand the relationship between sales, cost of sales, and gross profit. To properly assign the percentages and compute for the correct values, follow these 3 steps. First, assign the markup rate to gross profit. Second, set whatever the base is as 100%. The base can either be the sales or the cost of sales. Third, compute for the missing rate using the formula sales minus cost of sales equals gross profit. Now let's try applying these steps here. Let's assume we're given sales of 100,000 pesos and a 20% markup rate. Compute for the cost of sales and gross profit amounts, assuming the markup is a markup on or above cost and assuming the markup is on sales. First, let's plot the information we're given. we have sales of 100,000. Next, we have a 20% markup. Recall that the markup rate will always be assigned to gross profit. Next, 100% will be assigned to the base. The base will be the one defined in the term. So the base for markup on or above cost would be the cost of sales, and the base for markup on sales is sales. Now we can solve for the missing rate. Using the formula sales minus cost of sales equals gross profit, the sales percentage for the markup on or above cost would be 100% plus 20% or 120%. For markup on sales, the cost of sales is 100% plus 20% or 80%. Now that we already have the rates assigned, we can compute for the value of cost of sales. Let's start with the markup on or above cost. Here we know that the sales is 120% of cost of sales. We can use algebra to get the value of cost of sales by simply dividing 100,000 pesos by 120%. Solving for x, we get 83,333 pesos. Then we can now solve for gross profit by deducting the cost of sales from sales. We get gross profit of 16,667 pesos. Now let's try computing for the values under the markup on sales. We know that cost of sales is 80% of total sales, so using algebra, we can solve for cost of sales by multiplying 100,000 by 80%. Solving for x, we get 80,000 pesos. After that, we can now solve for the gross profit by deducting 80,000 from 100,000, and now we get gross profit of 20,000 pesos. Alright, so finally, we're now in the last section of our discussion for today, and here we will be applying the concepts we learned earlier by journalizing merchandising transactions. Today, we will be journalizing the transactions of MA Computers, which is engaged in the sale of laptops, computers, and computer parts. Here is a summary of all the transactions to journalize. You can look through them first before we go through them one by one. Also take note that we will be recording the transactions using the periodic inventory system. Okay, so let's begin. January 1, Megan Abad invested 3 million pesos cash into the company. To journalize this transaction, we simply debit cash and credit Abad capital for 3 million each. January 2, purchased computers for office use from AB Electronics for 50,000 pesos. Even though MA Computers is engaged in the sale of computers, the computers here are not merchandise inventory, and they will be recorded as office equipment since it was specified that these will be used in the office. We therefore debit office equipment and credit cash for 50,000 pesos each. January 3, paid rent for 6 months beginning January 2020, 180,000 pesos. Since this is an advance payment, we will be debiting prepaid rent and crediting cash for 180,000 pesos. January 5, purchased 50 units of laptops from MX laptop manufacturers for 2,200,000 pesos plus 5. 30% down payment, balance on account. Terms 510, 315, net 30, FOB shipping point collect 12,000 pesos. Here the company purchased computers. Since the company is engaged in the sale of computers, this transaction would be the purchase of its stocks for resale. Under the periodic system, we debit purchases, but by how much? It says here that MX Laptop will be providing a 5% trade discount to the total of 2,200,000 pesos. To compute for the invoice price, we simply multiply 2,200,000 pesos by 95%, which equals to 2,090,000 pesos. It says here that the company paid 30% down payment, so we credit cash for 30% of 2,090,000 pesos or 627,000. Then we credit accounts payable MX laptop manufacturers for the remaining unpaid balance of 1,463,000. But we're not done yet. The transaction also includes the freight terms FOB shipping point collect for 12,000 pesos. So we need to check if an entry is necessary in the company's books. FOB shipping point means that the buyer will shoulder the freight. The company is the buyer here, so we need to debit freight in for 12,000. Collect indicates that the buyer, in this case the company, also made the cash payment, so we credit cash for 12,000 pesos as well. Once you get used to journalizing, you can simply put the two entries together and make one compound entry like this one here. Values are computed the same way. January 6. Purchased 20 units of computers from ABM Computers Inc. for 680,000 pesos. Terms 215, net 30. FOB shipping point prepaid 8,000 pesos. This is another purchase transaction, so we debit purchases for 680,000 and credit accounts payable ABM Computers Inc. for the same amount. Although it was not explicitly stated that the purchase was made on account or on credit, the credit term 215 and 30 indicates that the sale was made on account. Again, always remember to record the freight entry if necessary. So let's check the terms. FOB shipping point prepaid. Since the term is FOB shipping point, the company, the buyer here, debits freight in for 8,000 pesos. Since the term is prepaid, the seller, ABM Computers, was the one who made the cash payment first. So the company here will credit accounts payable ABM Computers Inc. for 8,000 pesos instead. Here is the compounded entry. The accounts payable from both entries were added together to get 688,000 pesos. January 7. Sold 12 units of computers to Compex Trading for 600,000 pesos. 20% down payment, balance on credit. Terms 215, net 60. FOB shipping point prepaid 5,000 pesos. This is a sales transaction. Since the terms are 20% down with balance and credit, we debit cash for 20% of 600,000 or 120,000 and accounts receivable for the remaining balance of 480,000 pesos. We also credit sales for 600,000 pesos. Again, since the freight term was included, we have to check if an entry is necessary in our books. FOB shipping point means that the buyer, Compex Trading, will shoulder the freight cost, while prepaid means that the seller, or in this case the company, will make the cash payment first. So to record this entry, we debit accounts receivable Compex Trading and credit cash for 5,000 pesos each. Here is the compounded entry. The 5,000 pesos credit to cash is netted against the debit of 120,000, while the accounts receivable debits are added together. January 8. Purchased 30 units of computer parts from DC Units for 95,000 pesos, less 10, less 5. Terms 210 and 30. Freight amounts to 4,000 pesos, FOB destination point prepaid. This is again a purchase transaction. We debit purchases and credit accounts payable. The amount of purchases should be recorded net of any trade discounts, and so we multiply 95,000 by 90% and by 95% to get the invoice price of 81,225 pesos. Next, let's look at the freight terms and check whether an entry is necessary in our books. The terms are FOB destination point prepaid, which means that the freight should be shouldered by the seller, DC Units, and will also be paid by the seller. No entry is necessary in the company's books. January 12. Sold 20 units of laptops to PC Lab for 1,040,000 pesos on account. Terms 215, net 60. Freight is 12,000 pesos, FOB shipping point collect. This is a sales transaction, so we simply debit accounts receivable PC Lab and credit sales for the total amount of 1,040,000 pesos. Then let's check the freight terms. FOB shipping point collect. This means that the buyer, PC Lab, will be the one shouldering the freight cost and will also be the one making the cash payment. Therefore, no entry is necessary in the company's books. January 13. Received 250,000 pesos from Compex Trading as partial collection. Here we simply debit cash for the collection and credit accounts receivable, both for 250,000 pesos. Since this is only a partial collection, we don't have to check for discounts. January 15. Paid 50% of the outstanding balance with ABM Computers Inc. This is a settlement of outstanding payables, so we debit accounts payable, ABM Computers Inc., and credit cash. But how much? It says here 50% of the outstanding balance, so we need to compute for the total balance as of January 15 first. Let's use a T account to analyze the movements in the company's payables. Reviewing all the transactions to date, we see that the only transaction relating to ABM Computers until today was the purchase made on January 6. There is a credit of 680,000 pesos for the purchases and another 8,000 peso credit for the freight in. This gives us a total of 688,000 pesos. Now we can compute for the total amount of partial payment. 688,000 pesos times 50% gives us 344,000. And now we add this payment to our T account to update our monitoring. January 16, returned a damaged computer worth 68,000 pesos to ABM Computers Inc. Here the company is returning a damaged computer it purchased from ABM Computers, which means that there is a reduction in its outstanding balance and an increase in the purchase returns and allowances. So we debit accounts payable and credit purchase returns and allowances for 68,000 pesos. We also update our monitoring of the accounts payable relating to ABM by adding a debit of 68,000. January 17, settled outstanding balance with MX laptop manufacturers in full. Okay, so now the company will be settling its account with MX laptop in full. So the first thing we need to compute is the total amount of payable that should be paid to MX as of January 17. Again, we're going to use the accounts payable T account to analyze the transactions. Referring to the list of transactions, we only have one transaction relating to MX laptop, which was the purchase transaction made on January 5. If we look at the entry on January 5, accounts payable was credited for 1,463,000 pesos. So we add that amount to our T account. There were no other transactions, so we can now debit accounts payable for 1,463,000. Now when you see full settlement, another thing you must check is the terms of the transaction and determine whether the company qualifies for a cash discount or not. For this transaction, the terms are 510, 315, net 30. Payment was made on January 17 or within 12 days from the date of purchase. This means that the company is entitled to a 3% discount. We therefore credit cash and purchase discount. Now let's compute for the basis of the cash discount. The basis of the cash discount would be the total accounts payable relating to the purchases, excluding any payables relating to freight, less any returns and allowances. In this case, there are no returns, so the basis would be 1,463,000. Multiplying the amount by 3%, we get a cash discount of 43,890. We deduct the discount from the total payable to get a cash payment of 1,419,110 pesos. January 18, PC Lab returned one unit of damaged laptop costing 42,000 pesos. Markup on cost is 15%. PC Lab is a customer who returned a damaged laptop to the company, so this is a sales return. We therefore debit sales return and allowances and credit accounts receivable PC Lab. By how much? Recall that sales returns and allowances should always be recorded at the selling price. Since we are only given the cost, we have to compute for the selling price using the markup rate. First, we fill in the details available. Cost of goods sold is 42,000 pesos and the markup rate is assigned to gross profit. Then we assign 100% to the base. In this case, the base is the cost since the term is markup on cost. We can compute for the sales percentage by adding 100 and 15%. Now we have all the rates we can compute for the missing values. The selling price can now be computed as 42,000 pesos times 115%, which gives us 48,300. January 20, Complex Trading settled its account in full. Complex Trading, a customer, will be settling its account in full. So the first thing we need to check is how much is the total amount of receivables that should be collected as of January 20. Looking through the transactions relating to Compex before January 20, we have the sales transaction on January 7 and the partial collection on January 13. Referring to the entry on January 7, accounts receivable was debited for 480,000 pesos for the sales made, and another debit was made for the freight amounting to 5,000 pesos. Referring to the entry on January 13, accounts receivable was credited for 250,000 for the partial collection. Now we get the outstanding balance of 235,000. Since this is a full settlement, we should check whether the customer would be entitled to a cash discount. For this transaction, the terms are 215 net 60. Payment was made on January 20 or 13 days from the date of purchase. This means that the customer is entitled to a 2% discount. The entry therefore is a debit to cash, a debit to sales discount, and a credit to accounts receivable. Now let's compute for the basis of the cash discount. The basis of the cash discount would be the total amount of receivables, excluding receivables relating to freight, less any returns and allowances. In this case, there are no returns, so the basis would be 480,000 pesos. Multiplying the amount by 2%, we get a cash discount of 9,600 pesos. We deduct the discount from the total receivables to get the cash collection of 225,400 pesos. January 21, settled outstanding account with ABM Computers Inc. in full. Since the company will be paying its account in full, let's first check the total amount of payables that should be paid as of January 21. Looking through all the transactions with ABM before January 21, we have the purchase transaction on January 6, the partial payment on January 15, and the purchase return on January 16. Referring to the entry on January 6, accounts payable was credited for 680,000 for the purchase made and also credited for 8,000 for the freight. Referring to the entry on January 15, accounts payable was debited for 344,000 pesos for the partial payment. Now looking at the entry on January 16, accounts payable was debited for 68,000 pesos for the purchase return made. Now we get the outstanding balance of 276,000 pesos. Since this is a full settlement, we should check whether the company would be entitled to a cash discount. For this transaction, the terms are 215 net 30. Payment was made on January 21 or within 15 days from the date of purchase. This means that the company is entitled to a 2% discount. The entries therefore debit accounts payable, credit cash, and credit purchase discount. Now let's compute for the basis of the cash discount. The basis of the cash discount would be the total accounts payable relating to purchases, excluding payables relating to freight, less any returns and allowances. So we have 680,000 less the returns of 68,000, and we get 612,000 pesos. Multiplying the amount by 2%, we get a cash discount of 12,240 pesos. Finally, we deduct the discount from the outstanding payables of 276,000 to get the cash payment of 263,760. January 24, paid balance with DC units in full. Since this is a full settlement, we need to compute for the outstanding balance with DC units as of January 24. The original purchase transaction occurred on January 8. Looking through the other transactions, there were no other transactions relating to DC units before the settlement date. Referring to the January 8 entry, the accounts payable recorded amounted to 81,225 pesos. Again, since this is a full settlement, we should check if the company qualifies for a cash discount. The terms here are 210 net 30. Since the payment was made on January 24, or 16 days from the date of purchase, the company is not entitled to any discount. Our entry therefore is simply a debit to accounts payable and a credit to cash for the balance of 81,225. January 28, PC Lab settled its unpaid balance in full. Again, this is a full settlement, so we need to compute for the total outstanding balance of PC Lab as of January 28. The original sales transaction occurred on January 12. Then on January 18, PC Lab returned one damaged laptop before it decided to settle its account on January 28. Referring to the January 12 entry, the accounts receivable was debited for 1,040,000 pesos for the sale. Referring to the January 18 entry, the accounts receivable was credited for 48,300 for the return. We can now compute for the outstanding balance as of January 28, which is 991,700 pesos. Again, since this is a full payment, we should check if the company qualifies for a cash discount. The terms are 215 net 60. The payment was made on January 28, which is 16 days from the date of purchase and beyond the discount period, so PC Lab is not entitled to the discount. Our entry, therefore, is simply a debit to cash and a credit to accounts receivable for the outstanding balance of 991,700 pesos. And lastly, here are some reminders to avoid common errors encountered when journalizing merchandising transactions. On the date of purchase, keep in mind that the purchases are recorded net of any trade discounts granted. Also remember to record the entry relating to freight, if applicable depending on the terms. A lot of students would record the purchase transaction but fail to record the freight entry. On the date of full payment, always remember to check if the company is entitled to discounts. Also remember that the amount of cash paid or received plus the discount is always equal to the total amount of payable or receivable. The discount is always recorded on the same side as cash. Also take note that the amount of outstanding accounts payable on the date of payment and the basis of the cash discount are not necessarily the same. To compute for the amount of outstanding payables, we deduct partial payments and add any payables relating to freight. But to compute for the cash discount, we do not consider payables relating to freight since freight is not subject to discount. We also do not deduct the partial payments since these are still entitled to cash discounts. Lastly, keep in mind that purchase returns are recorded at cost, while sales returns and allowances are recorded at the selling price. That's it for today's lesson. I hope everybody learned something new. Please don't forget to like, share, and subscribe to our channel. And if you have questions or requests, feel free to comment down below. And I'll see you all in our next video.